Saturdays 3 p.m. I was going to say Saturday 6 p.m., but for your time Zoom might be right, but not mine. This is here is a Central Standard Time, 3 p.m. Today's topics are brought by a regular demand. People coming in, our client coming in, wanting to know whether it would be okay to borrow money from my own business. It just feels like they shouldn't even ask that question, right? It's your own business. What the heck? You can borrow whatever you want. But it's not so. So we want to talk about that today. And on the screen, you will see Community CPA's website, communitycpa.com. Come over here and you will see what we treat as a news for you. So we have, obviously you can tell, we are one of the 10 best firm for technology. That is published by Accounting Today, is one of the largest accounting professional publication. Then of course we have our Houston, Texas branch coming up. So these are highlights we want to impress you with. Here in our website, you can find these buttons, right? You can onboard with us right here, and through your own ways, you click the button, you can start uploading your information and sending a note to us. So you can onboarding with our service midnight when you have time, when no one else has time, right? So our business owner is that way. Sometimes the only time you're available is after 9 p.m. It's so awkward to call someone at the professional firm. So you come over here, you can onboard with us like that. Or you can go to appointment button to make appointment with us. You actually can see our calendar to see whether we're available or not. So it's a really good place to connect with us. Of course, all of our YouTube channel webinars we do today, yesterday, last week, last month, and last year, all of them are actually here at YouTube channel. And subscribe to our channel, then you will always get notification what we will be talking about today. You may not have time today at 3 p.m. Central Standard Time, but you might have time when you're doing other things or driving. You can tap into our YouTube channel, listen to what we have to say about a certain tax topic, right? Now, without further delay, let's go ahead, dive into what we want to talk about today. It is called borrowing money from your own business. Is it tax-free? So this is a question. That's literally a question from a client. We just quote this client and try to bring you that knowledge. And we prepared our slides to guide us in our conversation. And our first few slides is about our firm. And let me take up your precious time, just tell you who we are. Community CPA is not a firm that bought another firm, become big. We organically grow our firm. And in fact, we don't have successful acquisition, so I wouldn't even call it, had any impact to our firm. We just organically grow. And we have been here for 26 years and plus, and we speak 10 different languages collectively by our professional folks here in our firm. Of course, our client is truly worldwide. We have clients who do business in U.S. and wouldn't need a U.S. accountant, so we're here. And we also have client who does business overseas, so would need to understand how to handle these overseas income and expenses and their structures as subsidiaries, or they're just arm's length vendor relationship, all of that, and they become our client. We also want to tell you that we are expanding to different geographical areas. For example, our number 5 expansion is at Houston, Texas. Office is already done. Office renovation is done. Beautiful office. And we're just waiting for furniture to come. Then we can start operating as usual. And I myself I am the CEO for Community CPA. I'm also the managing partner for the company. And I have served as National Taxpayer Advocacy Panel. This is the federal advisory committee that provides advice to IRS. I served there for 3 years. Now, this is 2 books I wrote. It's already published. But I'm doing the 2 p.m. book, which is expanding your business. That's literally what I'm doing right now for Community CPA as well. So that book will be published at the moment where I felt my expansion of Community CPA service is successful. Right now, I'm still in the trial and error, learning it on my own, learning it with you. And a lot of my clients are at this stage as well. They're expanding. So we exchange our thought, follow the path, and I hope that through the journey together, and we're all gonna reach to a better place. So wait for my 3rd book, Appointment with Ying, at 2 p.m. Webinars is webinars, right? And whatever you got from internet, you want to take the information in responsibly, making sure that what we say is exactly meant for you, and study as much as possible. And if you don't have time for studying, don't even have time to listen to the end of the webinar and just call in, go on to the appointment button and make an appointment with us, then we will come to help you. And engage professionals to help you with your decisions, with your endeavors, with your business expansions. It is so important. It has to be part of your business journey to be successful. All right, and let's just dive in the reality show. So the reality show in today's economy is interest rate is high. Yes, it's coming down a little, but it's still high. So with interest rate is high, when you needed money, say you want to buy a vacation home, and you do not have money in your personal account, but you have money in your company account. And that happens a lot, right? If you're a business owner, you know exactly what I'm talking about, and you know how that is. So you go ahead, told your bookkeeper, oh, write a check to me for $250,000 from the company, my company, and the memo line, put that as a loan to shareholder. I'm the shareholder. I'm the only shareholder. So put that line there. Loan, loan, loan. It's not my income. It's a loan. So then you add it, I'll pay it back soon. Then what happened to the word of soon? Is dragged down for 3 years, right? At the end of the 3rd year, and the auditor barged in and auditing your company's book. So the auditor determined that your $250,000 is not a loan, and the auditor reclassified that $250,000 to be your income. And some auditors are nicer, and knowing that you're running a C Corp, so they're classifying that as your dividend. Whether it's an income or dividend, it has become a consequences to your 1040, because you have to reflect that, right? So you will face a big tax bill. Minimum is $50,500, because you got to pay for the rate, and then with penalty and interest. So look at that. So you borrowed money, and you are the owner. So you borrowed your own company, and nobody's going to say no to you. Your bookkeeper will write the check for you because that's what you needed, right? And you say, oh, I'll pay it back, but you never did. And then you got audited. The IRS will say, no, that's not loan. That's income, right? That's one reality show, but there is a nightmare show too. So what is the nightmare? The nightmare is that you get audited. And you were so confident. Oh, I do everything right. I don't have anything to hide. I am so good. So you go through the audit. You did everything right, but somehow you borrowed money from your company, and the auditor pointed out the number on your balance sheet, which you go, I don't understand balance sheet, and I don't know what happened to that. I just know that I don't owe taxes. And never mind, on your balance sheet, even though you did not know you borrowed money, but your bookkeeper and your tax accountant, somebody who finalized your taxes for IRS, submitted to IRS on that balance sheet, it has $250,000 you borrowed from the company. Does that ever happen to you? That happens to a lot of people. And sometimes when clients move their tax preparation to our firm, and we are very sensitive to that line because that means you have to pay taxes for it. And the client, a lot of time the client will say, I never borrowed that money. And I can tell you that I never did. I don't know why that number is there. And maybe my bookkeeper just made a mistake. No, they didn't make a mistake. What happened is right here. This is the balance sheet. This is the balance sheet the IRS will see. This is the balance sheet that reconciled to your book. So on that circle I drew there, that's a loan to shareholder. Sometimes when you are business owner, let's say you just use company's money for your personal stuff. Let's say you used company money, bought this vacation home. You didn't even bother to tell your bookkeeper, but your bookkeeper write the check out to the closing company and you have $250,000 out. This $250,000 cash out, it either need to be expense or it need to be some sort of asset on the balance sheet. Otherwise, how do you reconcile the money goes out to pay for what, right? So a lot of times your bookkeeper or maybe your tax preparer really understands you. They know that you spend money out of the company for your personal stuff. So they gathered all of these money together. They came up with a total and they put that under loan to shareholder. And you may not be aware of that, but they needed that number to balance your cash flow, to balance your balance sheet. Otherwise, you may have a small asset and a big liability plus equity. Then they have to put up a number to balance the balance sheet, so they stuck a number right there under loan to shareholder. And I want to bring this chart, this form in front of you because I want you to be so aware of that could be a potential tax liability to you, and you do not want any number showing up there and which you say you do not know. And you signed the tax form. So if the IRS come to audit you got $250,000 sitting there, IRS will run that into your taxable income. Then you will end up paying taxes. Worst, you're not paying taxes currently. You're paying taxes for 3 years ago you took the $250. So interest penalty, it will be a basket case. So you want to make sure that when you borrow money from the company and you want to know exactly what you borrowed, and following this, what we talk about will teach you how to make that not your income. But if you don't even know, you have no agreement, you don't even know you have this amount, you get audited, it is absolutely your income. All right. And as a business owner, we want you to be aware of these things. If the amount you borrowed from company is something that you are not aware of, okay? Just because your tax accountant, your accountant put in the balance sheet to balance your balance sheet, and you want to make sure that you dig into it, correct it, and make it right. If you really did borrow at the end, for example, you were just buying McDonald's for yourself years after years, so all of these little lunches, and your accountant says, boss, it is not the company expense, it is your expense, which is true, it is your expense. So we add up the burger price together, and for this year, it come up with $5,000. So your bookkeeper will put the $5,000 as the amount you took from the company, you borrow from the company, and to pay for whatever you want. So that is a concept, right? So they could do that. So on your balance sheet, you could see a $5,000 right there. So with that said, you want to be aware your personal expenses can be treated as a loan from the company. You owe company that money. That is the loan you borrowed from the company. And since that number is submitted to IRS on your tax return, so you want to make sure that you take steps to get the document ready to prove that is a loan, not income. Because if you can properly document that is a loan, then the $5,000 doesn't show up as your income. Okay? Because you will pay the company back. You have a proper documentation. Of course, in today's environment, interest rate is really high, right? So we're still kind of remember not too long ago the rate was 3.some%. Now shake our head, it's already 7.some%. So it's like going up pretty drastically. And you may want to not borrow from the banks because they are too expensive and you company has cash laying around, so you're tempted, if you need money, you want to borrow from the company. You can borrow from your company. You are allowed to borrow from your company. And you have no limitation to borrow how much from the company. But there are things you got to do right to stay your position so you don't end up taking the whole $250,000 into your income, right? So just like our client earlier in this slide who wants to buy the vacation home, and you may decide to take the loans from your company and come up with a rate, come up with a payment schedule so nice. You don't involve with anybody else. Your company can finance this vacation home. In general, the IRS expected these companies to charge interest on related party loans, including loans to shareholder, at the rate that at least equal to AFR rate. AFR rate stands for what? Stands for applicable federal rate. The AFR rate is lower than the rate that is flowing outside in the commercial world, so that you always can do low rate for the loan you borrow from, you took from your company, but you got to have a rate. Loaning money from a business to its shareholder is a hot button for IRS to look at. IRS actually have a lot to say about that, so I summarized it for you. So the IRS said that, okay, if you want to borrow money from your own company, you are the shareholder, and we like to take a close look at this, and we want to determine whether that is your income or it is a real loan. There's 4 factors they look at. They want to determine, there's 6 factors actually the IRS and the tax court is looking at. But what they're trying to do here, IRS is trying to just make sure your check to yourself, it is a loan, it is a real loan, or it is a compensation, or it is a dividend, or it is a return of equity. Make sense? So if the business loans are more than $10,000, this is straight from IRS website. So if the business loan is more than $10,000 to the shareholder, IRS considers a adequate rate of interest must be put in place. If not, the payment to shareholder could be reclassified into something like additional compensation, something like dividend, and something like return of equity. All right? So all of that could come in for IRS to say it's not a loan. It is something you have to pay taxes for. So now, okay, to make that a loan, we talked about to charge a rate. So what rate is a reasonable rate that IRS cannot say anything about? IRS cannot cause trouble to you. They have to be okay with that. That rate is what we call the applicable federal rate. Your rate that you pay interest rate to your company, that rate cannot be less than this AFR rate. So let's look at the AFR rate. Each month, IRS publishes his AFR rate, which varies depends on how the economy goes. So the rate is always different. I don't know how they calculate, but it's always changing. If you fail to charge an interest or charge a rate that is lower than AFR, so you failed, you don't have an interest, or you charge a rate that is lower than AFR rate, the IRS require you to impute interest. Don't go there. Don't ever get into the calculation of interest, imputed interest calculation. Because what happened is we'll go back in time from the first day you borrowed, how much the interest is short, then it's compound to today. So it is a calculation that you can do it on the website. There are calculators to do that. But what I am saying to you is it's not as simple as I just say, a bad boy, just do it right in the future. No. The auditors will go through the painstaking process to calculate what interest rate you should pay, what interest amount the company need to claim as income. When you borrow money from your company and you're paying a rate, that's your personal expense. That may or may not be deductible, right? Just depends why you borrow that money. Maybe you're borrowing that money to buy a rental property that is under your Schedule E, then you can deduct the interest expense under Schedule E. But maybe it is just for your luxury item. You're just trying to buy a, the Cybertruck for fun. They don't look very fun, but, just in case you bought some toys for yourself, it's not business related. That expenses doesn't come out, right? You cannot deduct that. Am I right? But that expense is your business's income. So the IRS will go through the process to calculate how much more income your company should have claimed, you should have paid. So company tax is changing, and it's just gonna be a can of worms that if you get into that situation. If you already knew, after I talk about this webinar, you just wake up to the fact that you have been doing it all wrong. You have a big number under that loan to shareholders. And then you want to consult with us and to see what we can do to get that rectified. Loan can be inadvertently reclassified, leading to tax consequences. If that is the case, if your taxes was done wrong, that line should not be even there, then that is a correction needed because it has a huge tax implementation related to that number on your form. You can say that, well, I had it for many years. Nobody ever knocked my door, talk about it. IRS auditors never really questioned about it, and that's because you haven't met them yet. When you meet them, it will be a topic because this is what IRS cares. All right, this is the link that you can go to check up on the rate. The rate is published every month. Like I said, IRS publish this rate monthly based on the market. And from this schedule, I just screenshot a top portion of that. You can tell that it says 4.95% for short-term loans up to 3 years. So if you are now borrow money from your corporation for $250,000, you cannot give yourself a rate that is less than 4.95%. Make sense? So it's 4.4% of midterm loans of more than 3 years, but less than 9 years. So you see, these are the things that IRS already have in place. And sometimes you probably are amazed, like how many things that you thought that it's impossible to be some sort of regulation, but it turned out to be a huge regulation behind it, and you just never knew, right? This is kind of the area that when people do loan to shareholders, oh yeah, just plug a number and you can be done, your taxes is done. No, your taxes may be done, but your trouble just began. So with that said, you want to know that there is such a thing about having an interest rate applied to the loan that you borrowed from your company. How is IRS determines the loans? Like what is IRS decide this is a loan or not a loan? Let's look at these 6 factors I was talking about. So this happens at the tax court. So the IRS auditor is a one level of compliance, right? They come in, they audit you, they say you're wrong, and this is not loan. So they make determination. They say, pay taxes on this. They decided, right? The auditor decided. But you as a taxpayer, you don't have to agree with it. You can disagree with the IRS commissioner. And then, when we say IRS commissioner representing the whole IRS auditors. So you can disagree with the auditors, with the IRS commissioner, but you can you can file appeals to go to tax court, right? You file appeals, then the appeal office will work with you. If you disagree with appeals and the technical assistance consultation, I don't know how you call those IRS officers, but they're from TA side of technical assistance side. They come in to remedy the dispute. But if that didn't work, then you go to tax court. But at the tax court, these are the 6 things the tax court will use to decide whether the shareholder borrowed the money or the shareholder got income. Number 1, the size of the loan. The size of the loan. How big? If it is less than 10,000, they're probably not going to be so worried about it. But if it is more than 10,000, it's 10 million, absolutely. Number 2, the company's earning and the dividend paying history. So the company might have a huge earning, always paid adequate dividends to the shareholder. So then that maybe diminish the tendency to say that money is dividend, right? Because, dividend distribution apparently existed, right? And also provisions in shareholders agreement about limits on amount advanced to the owner. A lot of times, before you form the company, you have this operating agreement. In that agreement, it actually also says that how much a shareholder can advance money from the company. Then, of course, number 4, repayment history. That is the most important to me. If you borrow money, you for sure have a repayment history. If you don't borrow money, you just took the money to spend, you don't have repayment history, that is your income. So that repayment history is written by the time. I always say that in the tax world, if you can prove things with time stamp, for example, you prove your mileage with your actual mileage log, with the date, time, even better, that date and time is created at the time you are doing it, not retroactively created. So if you can label and, stamp on the time, you show that the bank transaction from 2 years ago has this $250 repayment every month from you to the company. How easy can that be to prove that is a loan repayment? That is easy. But it's difficult for IRS to argue that, oh no, that's your income. No, they can't argue that because you have the repayment history. The shareholder ability to repay the loan based on his or her annual compensation. So, see, that is another factor the tax court will look at, goes whether it is possible for you to pay it back. And then the shareholder's level of control over the company decision making. If you are the single shareholder and you make all the decision and everybody else is just running around you, then that probably doesn't help with arm length dealing, right? So obviously you can do special things for yourself. So you call it loan, but you don't really repay it, and you have so much control. So all of these 6 factors coming into the tax court, and the tax court will decide, all right, I agree with the taxpayer, this is a loan, taxpayer should not catch up on tax payment, right? That's the ultimate answer you wanted. You want that to stay as a loan. You don't want that to come out to be taxed. And to make it official is really important in terms of defunding what you're doing. You can get money from your company and you can spend it the way you want it, but you want to make that borrowing very official. You want to have documentation to trace what you are doing. So here, I listed 2 things for you to make it official. Making it official is really key. So number 1, to create a loan document. In that loan document, you need to have the amount, your interest rate, your prepayment, your repayment schedules, and any other collaterals in case you're not paying it back. Maybe the collateral is for you to work for your own company 5 years without getting compensation, right? So it's just things that normally you would see in the loan document. You may say that, oh, Ying, where am I going to get the loan document? I'm not a bank. No, you don't need to be a bank. You can just go to Staples to buy those standard loan document. And on there, these things are kind of has a line. You can just fill in the number. And if you are really just so not good with the word, you go, I don't even read English and I just don't know how to do the loan document, then write in your language. But including these items I listed and make that official. And to make that official, the second step is the step that even more critical. You have a document, perfect, but you got to have a time tracking record. So you want to have a clear track of the payment history. That requires you to have a separate bank account, right? You must have your personal bank account and your company bank account in order for anyone to see the money goes back and forth. So that is important, separate bank account. Accounting for interest and principal on company book. Since it is a loan, so the company book really should see the loan principal reduce, should really see interest income coming in. That's company interest income, right? So on your personal side, maybe or maybe not, you can deduct that interest expense. The only sure thing I can tell you is if you use the money to buy something that business purpose, for example, a rental property, for example, and your computer at home where you have a freelance business going on outside of your business. So those are legitimate expenses. If you use the loan you got from your company to buy things for you to do other things, then if the other things is business endeavor, then you can deduct that interest expense, right? I know there's bigger topic related to deducting business expense, just because there is a limitation as well for business to deduct business expense. But we can save that for another topic. But today, I just want you to understand, when you take money out of your business as a loan, you want to keep it as a loan. To keep it as a loan, you want to make it official. To make it official, you need to have these 2 things going on. Create a loan document and have a clear track of repayment history. But of course, above all, your interest rate needs to be reasonable. Cannot be 0, and it can be the same as the federal rate, but cannot be less than that rate, AFR rate. And I showed you where to look for that rate, so you know how that can come through. And of course, you can always come back to Community CPA. We will help you with that, right? With that, I want to go back to our list of people. On our website, when you click appointment button, you will see the partners. And all of us are available to you. You can book our appointment. And if you already have that situation, I advise you to look at your tax forms to make sure that you don't have a loan to shareholder amount sitting there. If you do, you know that you should work on that to make sure that you're in the top compliance with the IRS requirement. I always say that, I have business client who would come to me and, new to our firm. When we explain this and that, the business client's answer would be, I don't think so. I have my friend who has been doing that for years, never had any problem, and I don't think that is that serious. It is really not serious when you are not being audited. But when you are being audited, when you are going through repayment of these penalties and interest, it is becoming serious. So my take is always that if you knew there is a procedure to follow and you want to do it right from get-go, why following into a wrong habit, which not going to help you in the long run? Why not establish it right from get-go? And you're here, so you obviously know Community CPA. If you know Community CPA is suggesting everyone to follow through these guidance, that is because one day when you get audited, you'll be so thankful because we are the one told you what the auditor would be looking at. And you already got everything prepared, even though you got a big number on loan to shareholder, but you are still tax-free on the loan on your personal side because it's a loan. The only expense you're going to have is interest expense. The only income your business is going to have related to the loan they give you is that interest income. So that solves a lot of headache. You don't have to come up with $50,000 on taxes, plus in addition, you'll get penalty and interest charges, right? So you see, all of us are here, and you can tap into our resources, get your question answered. Do you know that we have YouTube channel that you can subscribe? That way you can always be informed of what we are talking about. This email address you see right here, Catherine@communitycpa.com, she collects your idea, turn that into our talk like today. And so we have so much content in our YouTube channel. We're struggling to put in which content for which week. We're not struggling with answering what question. Makes sense? So you are doing a great job in supplying us with your question. We want that to keep going. At the same time, we are the only CPA firm. I know. I checked on internet from time to time. We are the only CPA firm open 6 days a week, Monday to Saturday. So with that, I want you to know we're special, we're willing, we're ready. And if you have any questions, contact us. And if you have loan to shareholder on your corporation tax return, you know what to do now to get your paperwork ready and put yourself in the right place before IRS knocking your door. Talk to you soon. Bye-bye.